Yields pulling back right now as we see the 10-year yield at 4.48% on the longer end of the curve, 30-year yield at 4.66. To break down the moves, we've got Vishal Khanduja, Morgan Stanley Investment Management Managing Director. Vishal, good to talk to you today. Let me just get your take on what we got this morning as we see the yields pull back on the end of it.
Good morning. Thanks for having me on. I think the report was spot on from what what Chairman Powell told us on Wednesday, continuing to rebalance with weak undertones. So it leaves the bond market almost at a point where it releases a lot of that pressure that was building up. There were three big things happening. If you look at just the microcosm of just this week, there was the quarterly refunding announcement by the Treasury, again, a very benign one, a dovish FOMC, again, guiding us to that we are still hesitant about cuts, rightfully so, but then very confident that the next move is very unlikely to be a hike. So that releases another, a lot of pressure, and then not so hard in a very balanced NFP report here that we saw this morning.
So, Vishal, that release and pressure, I mean, what does that suggest in terms of where Treasury yields move as we see it pull back today? Are we going to continue to see it sort of closer to that 4% level?
I think closer to that, 425 to 450 is where the 10s settle down, in our opinion. The inflation data, as Chairman Powell and all the Fed voting members have told us, needs to do a lot of the hard work. And that's why we don't think that right now, I think the data is not guiding us towards a sub 4% on the 10-year. So I think around this 425, 450, pricing in about 0 to 2 to 3 cuts this year and probably another 4 to 5 cuts next year is where we think fair value should lie for both the front end as well as the 10-year here in the market.
How many more employment situation prints like this for the month of April do you believe that the Fed needs to see in order for it to firmly believe it has reason to cut?
I think 2 to 3 more of these consistent ones that you need to see that unemployment is not completely taking a leg higher here, that consistent slowing of the inflation pressure. And the number that I have in my mind on that one is that the wage pressures or the wage inflation, it's a positive thing for workers in the employment force. It's still higher. It's still running higher than the actual inflation prints in the market. So that is positive. But then that is the one that the Fed is also closely watching, and we are closely watching as well. But it ticked down this month about 6.7% quarter over quarter. If you look at the seasonally adjusted rate, again, it was much higher that was the first quarter one, and it's ticked down with this report. So it seems like that April number was a little bit of that strong blip that we had seen because the revisions that we saw in March. So we believe that another probably 2 or 3 reports like this, which should be then seeping into the inflation prints for the next 2 to 3 times, which guide the Fed a little bit more comfortably towards those cuts by the end of the year.
Vishal, what does that investment thesis look like for you right now, specifically in fixed income? Is it still weighted more towards corporate credit, or are you starting to mix things up?
Still very, I would say that still very constructive on corporate credit. I think we look at 3 fundamental things there, valuation fundamentals, technicals, and valuations. We call it the FTV. We are still very bullish on corporate balance sheets here. Yes, dispersion is increasing, which is rightfully so at this time of the cycle. You are seeing certain balance sheets deteriorate. So as actively, if you can be away from those and then take opportunities in the ones that are fundamentally strong, but broadly corporate credit fundamentally is very, very, very strong. Technicals are immensely strong right now. I think just to give you a sense, year to date, we've seen about 60 billion of inflows in US IG. Along with that, we've seen about 640 billion of new issue supply, which was approximately about 4 times oversubscribed. So you had 4 times more demand, that's 640 billion, and then spreads are tighter on the IG credit. So technicals are very strong, but valuations is where we are a little hesitant at this point, where we were quite a bit more overweight coming into the year, about that middle of Q4, as we heard from the Fed. but our overweights have increased. So we are moving some of that money back into securitized credit. Some of these non-agency MBS bonds, borrowers who bought their homes in 2019, 2021, sitting on a lot of home equity with 3%, 30-year fixed rate mortgages. That's the borrower that we like at this point. And then parts of CMBS market, again, that got painted with a broad brush because of what is happening in commercial real estate. So that's attractive as well.
Some good takeaways there. Vishal Khanduja, Morgan Stanley Investment Management Managing Director. Appreciate you stopping by.